Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at a couple large cap stocks to consider buying if you're a long-term investor. And those two stocks we're looking at today are Thermo Fisher and Visa. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into these two stocks we're going to look at today for long-term buyers, these large cap names that are worth maybe holding for years and years to come, it's worth just kind of breaking down what's going on with the market just at a higher level to give a sense of maybe why we're looking at these two stocks for longer-term holdings. So Wall Street confirmed that inflation and the Fed are continuing on the right track earlier this month. Many kind of then instantly turned their attention to debt ceiling talks, and rightfully so, given the potentially devastating consequences that a default would and could have. But Washington drama is also really good for headlines and clicks and readership. So despite all those terrifying headlines and some of the worrisome kind of partisan discourse and back and forth, the deal is pretty much almost certain to get done. And then we saw President Biden and House Speaker McCarthy finally begin to echo that sentiment around midweek, saying McCarthy said on CNBC that, quote, "I think at the end of the day, we do not have a debt default." And then Biden that same day from the White House said, "We are going to come together because there is no alternative. Every leader in the room understands the consequences of failure." So Wall Street then turned bullish on Wednesday and Thursday on the back of these positive reports, and Biden and McCarthy both essentially saying a deal is going to get done. And I think that's kind of the growing sentiment. There's this fear that there's possibility of it happening, but debt ceiling talks have happened many times before, and this eventually cooler heads will prevail because, as Biden said in his words, there is no alternative. Like, the U.S. cannot default, so it will happen. Knock on wood. But so once that gets through, then people can start looking back to the fact that even Walmart and Target are kind of reporting these continuing strong results that the big tech names reported earlier in the first quarter. And with all of this, the S&P 500 is now up around 9% in 2023 and now about 7% in the past 12 months, even in the face of all that inflation and falling earnings and a slowing economy and geopolitical unrest. And now, as I said, more recently, these debt ceiling fears. So despite that climb, though, it's still about 15% below its peaks. Meanwhile, the NASDAQ's now up almost 20% year to date, but it's still 5% below where it was just in August of 2022 and 22% below its records. So there's not that euphoria all the way back in the market. So there's no need to be afraid like, wow, they've gotten way out of hand again already. But the positivity is back. And if earnings outlooks continue to hold up, we don't start to see hugely negative revisions or negative revision trends for the back half of 2023 or 2024, and inflation continues to ease its way down, the market could continue just to rise and rise and rise. And with that in mind as well, the performance over the last year, which includes obviously short-term peaks and valleys, highlights though why longer-term investors, if you're investing for years and possibly decades, which many of you are, you don't want to try too much to do the market timing game because missing some of the best days, which are often followed or like are near some of the worst days, has a proven negative impact on your long-term returns. And just, it's a bad thing to try to get in and out of stocks all the time. So if you're a long-term investor, obviously you can try to get in and out of some maybe flashy names and you want to be more of a trader on some. But if you're a long-term investor, you don't need to try to time things too much. So the two names we're looking at today, even if they fall a little bit more in the near term or have a pullback once you buy them, if you're going to be holding on for 5, 10, maybe even 20 years, it's likely that these two names will look like these levels are cheap today compared to what they will be down the road. So the two names we're looking at today, as I said, are Thermo Fisher and Visa. And we're going to start by looking at Thermo Fisher, which trades on the ticker TMO. It is a diversified medical device powerhouse that services tons of different health and healthcare related fields. So overall, it's a leader in laboratory equipment, analytical instruments, and technologies. in specialty diagnostics tools that are used across healthcare, pharmaceuticals, and biotech. The company benefited pretty hugely from COVID testing. It helped propel its adjusted earnings from about $12 per share back in 2019 to over $25 per share in 2021. So just that massive jump in a 2-year stretch. The firm's obviously facing a bit of a slowdown as that revenue stream fades, but Thermo Fisher is a robust company that was posting big growth long before COVID, and its outlook when we head into next year will show that it's going to bounce back pretty easily as well. So its offerings are going to remain essential no matter what. And it doesn't necessarily have that same boom bust cycle of some of the biotech stocks individually or big pharma stocks. The company had grown its revenue rather consistently for 15 years running, with the only setback being in 2009. And then overall, just to get a sense of where they're making their money, about 57% of revenue comes from pharma and biotech, 13% from industrial and applied end markets, 17% from diagnostic and healthcare, and then another 13% from academic and government, with 18% coming from its instrument segment, and about 40% coming from its services segment, and 43% coming from consumables. So that helps that diversified business. And then these are some things that people constantly need. So with this in mind, Thermo Fisher topped our Q1 earnings revenue estimates back in late April. And its near-term guidance for 2023 is down ever so slightly, down just from $23.72 per share to $23.70 per share, so just 2 cents. And then looking ahead to 2024, its estimates actually up slightly. So it's landing as Zacks ranked number 3 hold at the moment. And if we look in terms of growth for the year, we're calling for about 2% bottom line growth and about 1% top line growth, and then a return to big double-digit growth. 12% growth is expected on the bottom line next year, and then 7% revenue growth, which would come on top of 14% revenue growth, or nearly 15% revenue growth in 2022, 22% growth in 2021, 26% growth in 2020, 5% growth in 2019, 16% growth the year before that. So you get the picture. That's just facing some difficult to compete against periods. And after 2023's 1% expected growth, we're going to return to 7% growth in 2024, and then a big bottom line expansion as well. And then overall, Wall Street's still really high in the stock. So of the 16 brokerage recommendations that Zacks has, 12 are strong buys, with 2 more sitting at buys, and then the other 2 sitting at holds. Overall, the stock's trading about 23% below its average Zacks price target at the moment, and about 20% below its peaks from 2021. The stock has chopped around for much of 2022 and 2023, with it now trading around where it was in February of 2022 and some parts of the summer of 2021 and even the end of November 2020. So overall, its shares are up about 55% still in the last 3 years and 500% in the last decade, versus the S&P 500. It's 160% run, and its Zacks Medical Instruments segment's 190% climb. So it's up 500% in the last decade versus 190% for its medical instruments industry. And technical focused traders might be a bit nervous about scooping up the stock right now with it back below both its 50-day and 200-day. That said, though, it's been swinging around its 50-week moving average over the last year plus, and it hasn't gotten anywhere close to its 200-week moving average, which is a good sign. And then in terms of its long-term RSI, it's about at its lowest levels that it's been. It's about neutral levels compared to way overbought at certain points over the last couple of years. So it's at the lowest levels it's been since about 2013 at the moment. So if you're, as I said, long-term investor, these levels shouldn't necessarily scare you, even if it drops a little bit further in the near term. So TMO is also trading 32% below its 10-year highs at just 21.1 times forward earnings, which is not too far off of its median over the stretch as well. And it's trading at a 40% discount to its industry. And it's consistently traded at a discount to its industry despite that long-term outperformance over the last 10 years. So that's good to see. And the company raised its dividend by 17% in 2023. Its yield's still pretty small, but it only has a 7% payout ratio, so tons of room for upside there. So Thermo Fisher is a potential pretty great long-term hold in your portfolio because of its ability to grow within the entire wider healthcare and pharmaceutical and biotech industry, just because it's able to supply these things that are essential at all times. And now we're going to close out with a look at Visa, which is another mega cap stock. So Visa is a credit card powerhouse that operates an elaborate back-end processing and payment network around the US and globally. Visa essentially grabs a small percentage of the nearly never-ending amount of credit card swipes and taps and more that pass through its insanely complex global payment network. Visa is poised to grow as the world becomes increasingly cashless. Visa is also obviously actively trying to evolve and fight back against that wave of young and hungry fintech upstarts. But despite all those names, Visa and MasterCard are still, which is its other big credit card player in the space, are still just operating such a big space that they're growing so much, double-digit growth for years and years, and probably years and years to come, despite all of that fintech upstart trying to get in on their business. It's also more recently benefiting from the booming travel market, which is expected to be really strong this summer and continuing as people kind of shift their spending from buying all the stuff for their houses and things like that back to travel and more services spending. So if you look in terms of their growth over the last decade, they've posted really huge Visa's posted really huge top and bottom line growth. It did 22% revenue growth last year, 10% the year before that. And on the bottom line, it did about 27% growth in 2022 and about 18% growth in 2021. The company beat our Q2, so it was Q2 2023 estimates in late April on the bottom line. And that was on the back of rising payment volumes. So overall, its earnings outlook is up about 2% for 2023 and then another 1% for 2024. So up just slightly, even though it still is Zacks ranked number 3 hold at the moment. And then if we look at our estimates, we're calling for about 11% revenue growth this year and then another 11% in 2024. So just this consistent double-digit growth. And then we're calling for about 15% bottom line growth this year and then another nearly 13% bottom line growth, so just earnings growth in 2024. And then of the 22 brokerage recommendations that Zacks has, 17 are sitting at strong buys, 2 more at holds, and then the rest two more sitting at buys and the rest coming in at holds. So no sells along with 17 strong buys out of just 22 brokerage recommendations. And then over the long haul, the stock's up about 415% over the last 10 years. Though it's moved roughly sideways over the last 2 years, it could now be ready to break out with it now back above both its 50-day and 200-day moving averages. And it's still trading about 8% below its highs, and it's near neutral RSI levels, so it still has plenty of upside in terms of that before it's overbought or anything like that. And it's up about 12% in 2023. So it's certainly not one of those overheated stocks, possibly like Meta and some of these names that are up already 100% so far this year. And it's trading slightly below its 10-year median in terms of forward earnings. It's trading at 25.2 times forward earnings, which is also a 34% discount to its own highs over the stretch. So its valuation is looking pretty solid as well. And then in terms of its dividend, its yield is about 0.8% at the moment, and it's increased its dividend by an annualized rate of about 16% over the last 5 years, and its payout ratio is sitting at a very solid 22% at the moment. So despite all of these fintech firms and everyone trying to edge out Visa, the credit card powerhouse remains a growth machine that's deeply entrenched in the economic and financial system that's seriously worth considering as a longer term play at these levels as well as with Thermo Fisher. So these two stocks certainly worth looking into as a longer term buy and hold kind of play that are these large cap / mega cap stocks. And that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.